Good morning and welcome to today's special edition trading update on the end of quantitative easing in the States. I'm here today with our independent investment advisor, Gerry Celaya from Red Tower Asset Management, and our very own discretionary manager, David Michael. So Gerry, as expected, the US Federal Reserve brought to an end the quantitative easing program, essentially ignoring the recent weakness in the financial markets. I suppose the obvious question is, do you think that quantitative easing has worked?
Yeah, it's a good question. And I think economists are, broadly speaking, economists would be saying yes, QE 1, 2, and 3 did what it's supposed to do, which is revive the US economy, bring confidence back into the system, pump up banks, pump up some of the asset markets, and effectively get the US economy back on its feet. The credit crunch in 2008, 2009 was horrible in terms of balance sheet destruction in the banks and other companies. And I think even though QE has a lot of critics in terms of what it actually does or doesn't do, at the end of the day, the numbers would say that the Fed did the right thing. The U.S. economy is growing at a pretty good pace. We're looking for Q3 GDP to come out later on today. Everybody's looking for a 3.0 Q-on-Q sort of number, annualized number. Q2 growth was around 4.6. So that's pretty good numbers. In terms of an annualized GDP, I think the Fed's looking for between 2 and 2.2% for this year, which is pretty much obtainable. And looking forward, you would expect that sort of growth to continue. Mm-hmm. Now, a lot of critics are saying that's not really good enough. In a big recovery, you should be seeing GDP blister away. The new normal sort of thinking would say, no, moderate growth is actually pretty good. In terms of the unemployment rate, you've seen that drop below 6% in the last reading. So more people are employed. And again, that the upshot, you have to say, wow, the numbers look pretty good. Yeah. And if you look at the stock market's done great since 2009. Russell 1000, Russell 2000, S&P 500, no matter which one you look at, the Fed has pumped up assets, which is more or less what they wanted to do.
And how do you think that the Fed will go forward now in terms of perhaps keeping their existing book, or do you think they'll look to wind down their assets that they have on their books?
That's a $4 trillion question. And I think everybody's looking at this going, okay, what are you going to do, Fed? Our view is that the Fed's going to basically do its best not to jolt the bond market. That's just obvious. They don't want to see the bond market run for cover. 1994 is still a big, what not to do when it comes to shocking the bond market. Yeah. Sort of a history lesson. So I think it's one of those things that the Fed's going to do their best to tell the market, look, we're not going to do anything to shock you. We're going to do our best to hang on to our bonds and our bond holdings, let them run off if we have to. Obviously, they have the wherewithal to participate in the market if they need to. So my view is if you see yields, let's say the 10-year spike down to 2% again, like we did a couple of weeks ago, the Fed could quite willingly say, well, have some bonds, calm the market down, see if we can get yields back up to 2.3, 2.6. I'm pretty sure they're happy to see yields in a 2.6, 3% sort of range until they decide whether to raise rates.
Yeah, fair enough. And I suppose as an investment committee, we've been discussing for some time that we're likely to see the Fed act first. In terms of raising interest rates. So do you think that that's still likely to be the case, or do you think with the recent news we've had in the UK, do you think there could be a chance for the UK to act first, or do you generally think the US will still go first?
To be honest, the US has been pretty straightforward in saying that they're going to raise rates at some time, right? Mm-hmm. And it's going to be probably between, let's say, April 2015 to maybe August 2015-ish. So Q2 maybe edging into Q3 at the latest, in my view, as long as as the Fed says, as long as economic data justifies the ability to raise rates, and they'll do it. The UK is a different kettle of fish, and I don't think Governor Carney's really helped matters too much with his forward guidance. He's gotten a lot of slack. He doesn't need me to criticize him, but it's one of those things where it hasn't really helped. Yeah. Going from steady rates to watch out for rate hikes to we don't really know what we're doing. The Eurozone economy is dragging on the UK in some ways, and it's likely to continue to drag in terms of economic performance, exports, and any sort of metric that you want to look at. There's really no huge reason for the UK to raise rates in a hurry. Yeah. So I'm not, in our view, with inflation more or less under control, job picture improving in the UK, but you should be looking for rate hikes sometime in 2015, probably in the latter half of the year.
It's very good for most of us mortgage holders in the UK.
Oh, yeah, definitely.
You touched upon the real winners of QE. I think that's undisputed. That's been equities, certainly. I mean, the S&P, for example, up 40%, over 40% since 2000 and the S&P has been up 40% since the start of QE3.
Right.
Do you think now is the time to be starting to consider rebalancing one's portfolio away from exposure to the US, or do you merely think that this is a momentum thing that's likely to continue going forth?
Yeah, it's really tough to argue about maybe another doubling of share prices, because you look at it and go, hang on a minute, we've come a long way.
Exactly.
And the temptation is to say, okay, take the money and run and do something else with it. But theoretically, you should be looking for the US yield curve to flatten over the next year, 2 years, 3 years.
Mm-hmm.
And that should, in theory, be really good for equities, because it has been really good for equities in the past. So what I would suggest is take a look at your exposure to the US. Obviously, keep some there. But if you want to play catch up with the leader, then have a good look at the Eurozone, have a good look at the UK. And these are lagging stock markets that are still maybe 1 or 2, maybe 3 quarters behind the US. And so I would be looking to expose myself more to those markets in terms of upside potential.
That's exactly.
Which seems a bit strange, but it's one of those, you've made good money in the US, keep some chips in there, but start thinking about where to put the chips next in terms of potential upside.
Sure. I mean, that's exactly what we've been looking at doing. As I say, we've been looking at the divergences between, obviously, the leading indicators such as the S&P or the Russell 1000. I mean, even in-house, you're just looking at the US allocation. The Russell 2000, for example, has underperformed significantly, as you know.
Yeah.
So again, that may be opportunities to present themselves if the US economy continues to carry on in the same trajectory, to consider the smaller cap markets in the US as well.
Yeah, that's one of the weird things about 2014 is that the mid to small cap companies have been unloved, and yet some of the data coming through is actually quite good. So it's one of those things where you have to look at it and go, okay, I think if we are rebalancing our portfolios, maybe more exposure to growth ideas on the view that the US economy is actually doing all right. Interest rates aren't going up in a hurry, and they will continue to do all right. So you would expect the small to mid cap shares to actually do well in 2015. Now, to be fair, 2014 has been a disaster for that view. So it's one of those things where you have to look at it and go, okay, my view is still more or less the same. Things haven't really changed that much, so let's try to stick with that and see if it works in 2015.
So going into 2015, certainly equities, just to reiterate, is still your asset class of choice?
Yes, it's one of those things where you should see upside potential. Historically speaking, in a flattening yield curve environment, equities do well. We've been cautious about bonds all year long, which has been wrong, because bonds have been all over the place. But it's one of those things where you look at bond deals and you think they're probably going to go to 3% in US govies, which means corporate bonds, mortgage bonds, those sort of things. We'll probably see them marked higher as well. That should leave equities as a pretty good play. Commodities are the bombed out play that we're looking at as well in terms of some sort of catch-up ideas. And that should take care of 2015, I think.
Brilliant.
Okay, well, thank you very much for watching. I hope this short briefing has given you some insights into Reyker's views on the end of the quantitative easing program. And thanks very much for watching.